Good morning to all of you. We are on 8th chapter of O.C. Chapter 8. Source of business finance. In previous lecture we have completed meaning of business finance, its importance. Now today we are going to start source of business finance. The actual meaning of this chapter, source of business finance. So total there are two sources. Sources of business finance. Internal sources, and second one is external sources. Now in case of internal sources, according to your textbook, three types are given. Internal sources is also known as owners fund. Owners fund. And external sources is known as borrowed fund. Now first of all, owners fund or internal sources, according to your textbook, total three types are given. One is equity share, second one is preference shares, and third one is retained profit. Retained profit is also known as plugging back of profit. Plugging back of profit. Now equity shares, in different forms we can issue equity shares. The first one is, according to textbook, ordinary equity shares. Ordinary equity shares. Second one is sweat equity shares. And third one is other equity shares. Other equity shares. Now preference shares, these are of two types: redeemable before 20 years and redeemable after 20 years. After 20 years. Retained profit has different names. It has different names. For example, general reserve, reserve and surplus, reserve, or this has different name. Another name is plugging back of profit. Now so far as external sources, these are also of different types, means borrowed fund. In borrowed fund, first one is debenture. According to your textbook, debenture. Then bond, second one is bond. Third one is public deposit. public deposit, fourth one is loan from financial institutions. So these are the different types of external sources. 1, 2, 3 and 4. Loan from financial institution or bank or commercial bank. The source of business finance. Here whole chapter has come. Internal sources and external sources. Internal sources is also known as owner's fund and external sources is also known as borrowed fund. Internal sources or owner's fund is of three types: equity shares, preference shares, retained profit. And external sources means borrowed fund. It has different types: debenture, bond, public deposit, loan from financial institution or loan from commercial bank. Now equity share, it has three types: ordinary equity shares, sweat equity shares, other equity shares. Here other equity shares, within bracket you can write other equity shares, within bracket you can write bonus share, right shares. These are other types of shares: bonus share, right share. Preference shares are of two types, which is redeemable. Redeemable means returned. Returning is called redeemable. Returning. For share or debenture, we are using the word issue and redemption. Issue means receiving amount. Redemption means returning amount. So redeemable before 20 years and redeemable after 20 years. Then retained profit, again general reserve, reserve and surplus. Various other names are there: accumulated profit, workman accident compensation fund, profit and loss account. There are different names which are called retained profit. So later on you will study in other chapters in 11th and 12th. External sources, these are called borrowed fund, debenture, bond, public deposit, loan from financial institution or loan from commercial bank. So total there are two sources of business finance: internal and external. Now new topic is equity share. Today we are going to start equity share. Page number 88. Equity shares. Now, what is the meaning of equity shares? The shares having last right to receive dividend as well as capital as compared to preference shares are known as equity shares. Meaning is given. The shares means total there are two types of shares: equity shares and preference shares. Equity shares and preference shares. Now what is the difference between equity shares and preference share? The person who purchase equity shares, first of all, this is about meaning of equity share. First of all, try to understand what is share. Suppose a company has to arrange 5 lakh rupees. They want 5 lakh rupees. Means this is called finance. They need 5 lakh rupees. And company, particular individual, there is no owner in the company. The person who starts company, that person is called promoter, not owner. And we all know if for a second we will assume that that promoter is the owner of the business, then what happens? The same characteristics which we have already studied in sole proprietorship, that one person or owner can bring only a limited amount of capital into the business, because it is company, it is based on huge scale, means it is based on huge fund, or we can say huge fund is required in company in order to administer company, in order to control the company, in order to do all the activities. We need a huge fund. So from where or from which sources we can arrange money for the company? That's why one option is there, that is called shares. Now what is share? Suppose now here we are assuming that company needs 5 lakh rupees, and they means promoter cannot invest this 5 lakh rupees all alone. So what is the another source? Another source is a share. How? If he will arrange this 5 lakh rupees from other individual, so one individual, any one individual or few individuals cannot contribute. Right now I have taken 5 lakh rupees, otherwise the amount is in crores and millions. So one or few individuals cannot contribute this 5 lakh rupees to that particular company. That's why what company does, that company is dividing the whole amount into different parts. Suppose each part is of 10 rupees. If we divide 5 lakh rupees divided by 10, so it comes 50,000. It means company has divided 5 lakh rupees into smaller part, and each smaller part is of 10 rupees, 10 rupees, 10 rupees. In this way 50,000 parts they have done of 5 lakh rupees. It means total there are 50,000 parts. This 50,000 parts means share. So instead of parts we are writing shares. Total there are 50,000 shares, and each share, each part is of 10 rupees. This is called face value. Face value. So if it means 50,000 shares means now total there are 50,000 shares, means 50,000 parts, each part is of 10 rupees. Now technically we can say total there are 50,000 shares, and the face value of each share is 10 rupees. Now out of 50,000 shares, any person can purchase, means each individual can purchase any number of shares according to their income, according to their capability. For example, out of 50,000 my capability is to purchase 500 shares. It means I have to pay 500 shares into 10, means reason is each part is of 10 rupees. So total I have to pay 5,000 rupees. In the same way, any person can purchase any number of shares, but total company has to sell 50,000 shares. Not more than that they can issue shares. Here total they need 5 lakh rupees. They have divided 5 lakh rupees into 50,000 parts, 50,000 shares. Each part is of 10 rupees. That's why it means in simple language we can say company can sell 50,000 shares, and technically it is called company can issue. In common language we can say company can sell 50,000 shares in the market, or technically we can say company can issue 50,000 shares in the market. This is called share. Now every investor wants to invest money into the company in the form of share. In the form of share. For example, I had purchased 500 shares. It means I had invested 5,000 rupees. Now why we are investing money into the company in the form of share? For some return. In order to earn some income, means we want some return on our investment. Now what type of return we are getting? After giving some amount, for example, I had given 5,000 rupees, some other individual will give 6,000 rupees or 10,000 rupees, other individual 15,000. In this way, company is able to arrange 5 lakh rupees from different investors. After arranging 5 lakh rupees, they are investing this money into the business, or they are expanding their business, or they are purchasing new machineries. Means anyway they are trying to utilize this 5 lakh rupees for the growth, for the development of the business. And at the end of the year, whatever money earned by the company, whatever money earned by the company, out of that earned profit, earned income, whatever money they had earned, first of all, out of this earned income, they are making compulsory payment. Compulsory payment means for the income, the expenses which is compulsory to pay. For example, electricity bill, salary to employees, wages to laborers, taxes to government, then outstanding balances to creditors, to other, for example, loan amount to bank, interest amount to bank if they have taken loan. After making all this compulsory payment, whatever amount is left, that is called residual profit. Residual profit, or in simple language it is called divisible profit. Divisible profit. So after making payment, after making all compulsory payment, whatever amount is left out of the profit, that profit is distributed among different shareholder, because the person who has purchased share is called shareholder. He has invested into the company. They are treated as owner of the company. They are just like owner. Who is owner? The person who is investing money into the business. In the same way, shareholders are also investing money into the company in the form of or by purchasing share, because they are investing money into the business. That's why at the end of the year, whatever profit company is earning, out of those earning, shareholder has right to receive some return. That return is called dividend. That return is called dividend. One line definition of dividend: the part of profit, the part of residual profit, part of divisible profit which is distributed among all shareholder, that is called dividend. Now, what is definition of equity share? The person who is purchasing equity share, means it depends on investors whether they want to purchase equity share or preference share. What is equity share? What is preference share? It depends upon their nature. It depends upon their characteristics. According to their nature, according to their characteristics, we can bring difference between equity share and preference share. Now, the person who purchase equity share, it means whatever amount, for example, I had purchased 500 shares, each share is of 10 rupees, total I had invested 5,000 rupees, and which share I had purchased? Equity share. It means whatever amount I had given to the company, means 5,000, or whatever amount I have to pay, means total 5,000, this 5,000 I will not get. This 5,000 amount, means this investment amount, I will not get during the lifetime of the company. Or in other words, company will not return the amount of equity share to the investor, to the shareholder. Only every year they will get dividend. Then when they will get this 5,000 rupees back? Only and only at the time of liquidation of the company, means when company winds up, when company closed down, only at that time they will get their 5,000 rupees. This is called equity share. So what is equity share? So they will get their money at the time of liquidation only. That is also after making the payment of outside liabilities, then after making the payment of preference share, after returning, we can say after returning. First of all, company will, suppose company closed down, then after selling all assets, company has to sell their assets, and whatever money they are receiving by selling the assets, when company closed down, company has to sell their assets, and whatever money realized from the sale of assets, out of those realized money, first of all, company has to return to outsiders, means borrowed fund. Suppose company has taken loan from bank, so it is compulsory for them to make payment to bank, to other financial institution, to debenture holders, to any other institution from whom they have taken loan. After making payment to outsiders, means borrowed fund, then company will return the amount of preference shareholder, means the person who has purchased preference share. After that, if money is left, then company will return the amount to the equity shareholder, means equity shareholders are getting their money back in the last, means after debenture holders, after preference shareholders. Second point, regarding dividend, we all know what is dividend. The part of profit which is distributed among shareholder is called dividend. In case of equity share, the rate of dividend is not remain fixed. Not remain fixed. The rate of dividend means whatever rate of dividend is decided. So for example, company has decided 3%. Company has decided to pay 3% of profit in the form of dividend. 3% of profit. If company has earned 50,000 rupees, suppose 3%, how much share I had purchased? 500. Means total invested amount is 5,000. So 3% of profit, suppose company has earned 80,000 rupees. So what is 3% of 80,000? 2,400. So here I will get 2,400. If company decided 2%, so 2% of 80,000, it means 1,600. Now right now I will get 1,600. So it depends on, sometimes dividend will decrease, sometimes we will get more dividend, sometimes we will get less dividend. It depends on rate of dividend, or it depends upon, we can say, on profit. If profit is more, so for example, rate of dividend is 3%. Once again I am taking, if company has earned 80,000 rupees, after making all compulsory payment, after making all expenses, electricity bill, interest to debenture holders, interest to bank, then salary, wages to laborers, after that company has earned 80,000 and rate of dividend is 3%. It means every equity shareholder will get 2,400, 3% of 80,000. So here in the first year I am getting 2,400 as a dividend. And if company has earned 1,60,000 instead of 80,000, then 3% of 1,60,000, it means 4,800. So if company is earning more profit, our dividend is also more. If company is earning, suppose company has earned 40,000 rupees, 3% of 40,000, 1,200. So here our dividend will reduce. So our dividend may fluctuate. It depends upon the profit earned by the company. If our company is earning more profit, our dividend is also more. If company is earning less profit, our dividend becomes low. Means our dividend on equity share fluctuates. It increases or decreases according to the profit. If profit is earned by company is more, then our dividend, means dividend of equity shareholder, is also more. If company is earning low profit, then the rate of dividend or dividend earned by a shareholder is also remains low. So this is the two main characteristics of equity share. 1, 2. First one is returning of capital, and second one is dividend. Now on this basis we are defining equity share. Equity shares are those shares in which the amount of capital is returned in the last and dividend is not fixed, it fluctuates. Such type of shares are called equity shares. Now according to the textbook, the shares having last right to receive dividend as well as capital. So they have last right. First of all, preference shares are getting dividend. After that, if profit is left, then out of those left profit, shareholders are getting dividend. So the shareholder or shares having last right to receive dividend, this is about every year, and to receive capital. Receive capital means at the time of liquidation. And this is every year. So on the basis of these 2 points, we are defining equity share. The shares having last right to receive dividend and last right to receive capital, such shares are called equity shares. Now characteristics of equity shares. Now total 10 points are given. Any 6 points you can do. First one is true honors. Any 6 points of your own choice. True honors. Second point is right to vote. Third one is rate of dividend. Fourth one is profit related. Fifth one is general meeting. And sixth, last one is repayment of capital. Repayment of capital. So any 6 points of your own choice you can take for explanation. So here I have taken first 6 points: true honors, right to vote, rate of dividend, profit related, and general meeting, repayment of capital. Now explanation of these 6 points. First, true honors. The person who purchase equity share, characteristics of equity share we are studying. Equity shares. So the person who purchase equity share are considered as a true owner of the company because they are taking risk. Sometimes they are getting low dividend, sometimes they are getting less dividend or more dividend. Sometimes in some year, if company incurs loss, in that year they are not getting any dividend. So they are taking risk by investing their money. That's why they are considered as true owner of the company. Now according to textbook, this type of shareholders are called true owners of the company or faithful companions because they take more risk than preference shareholder. Two types of persons who are purchasing shares. One is purchasing equity share, other is purchasing preference share. The person who is purchasing preference share, they are called preference shareholder and they are more secure. Now why they are more secure, we will explain later on. But they are more secure as compared to equity shareholders. Reason, equity shareholders are not going to get their money back during the lifetime of the company. First. And second, they are not getting fixed rate of dividend. Every year their dividend fluctuates. It depends upon the profit. If profit is more, dividend rate of dividend or dividend amount will also be more. If dividend profit is less, then dividend amount is also less. So they are taking risk. That's why they are considered as true owners. So taking a risk. That's why they are considered true owner. Now right to vote. The equity shareholders have right to vote in the meeting, to cast their vote in the meeting. One line explanation. Equity shareholders have right to cast vote as per share held by them. So whatever number of shares held by them, that number of vote they can cast. For example, if person has purchased 500 shares, then for 500 shares, he can cast 500 votes. So right to vote, he has right to cast votes in the meeting for making any decision. Rate of dividend, which is not fixed. Cast vote in the meeting for taking any decision. Rate of dividend which is not fixed. So rate of dividend fluctuates every year. It depends upon profit. So rate of dividend, that's why rate means here percentage. 3%, 2.5%. So some rate of dividend is not fixed. That's why dividend amount is also not fixed, because here rate of dividend means 3%, 2% of profit. If profit is more, so we will get more dividend. If profit is less, we will get less profit, less dividend. So rate of dividend, it also depends upon rate of dividend, which is not remain fixed every year. Fourth one is profit related. dividend receivables to such shareholders is related with profit, hence dividend will increase or decrease with profit. Again same explanation. This is rate of dividend means percentage, and profit related means dividend amount. We are talking about here dividend amount. Rate of dividend may also fluctuate. Sometimes in some year rate of dividend is decided by the company is 3%. In some year it is decided by the company 2.5%. So rate of dividend fluctuates. In the same way, because we are getting this rate of dividend out of profit, so it depends upon profit also. If profit is high, we will get high dividend. If profit is less, we will get less dividend. For example, if rate of dividend is 3% and company has earned 80,000 rupees, in that case we will get 2,400 rupees. If company has earned 1 lakh rupees, 3% of 1 lakh, then in that case we will get 3,000 rupees. If company has earned 1,50,000, 3% of 1,50,000, 4,500, means our dividend percentage is same, 3%. But our amount can increase if profit, company earned high profit. If company is earning 80,000, we will get 2,400 at the rate of 3%. If company has earned 1 lakh, we will get 3,000 at the rate of 3%. Percent is same. But amount of dividend, that is called profit related. So here dividend amount increase or decrease? Increase or decrease? According to profit. According to profit. Now rate of dividend and dividend amount both are different. General meeting means meeting of shareholders. Meeting of shareholders means meeting of equity shareholders. Whenever we are using shareholder, it means equity shareholders, because they are true owner of the company. Now general meeting, whenever company is conducting meeting of shareholders means equity shareholders, they have right to attend the meeting, they have right to speak in the meeting. Speak means discussion on the matters. They have right to cast their vote in order to take some decision. So general meeting, according to textbook, the shareholders have right to attend the general meeting, vote and elect the directors. They have such type of rights. Right to attend general meeting, cast vote we have already done, cast vote, and elect directors or take some other major decisions. The last one is repayment of capital. I have already told you that the person who purchased shareholders, equity shareholders, they will not get their money back during the lifetime of the company. They will get their money back only at the time of liquidation. At the time of liquidation means when company closed down, only then they will get their money back. Last, repayment of capital. Generally the share capital is not repaid during the existence of company, means during the lifetime of the company. They will get their money back only and only at the time of liquidation. So these are main 6 important characteristics of equity share.